Dave and Tom Moore, the Exchange Bros, shifting gears into self-directed retirement accounts. So we've got one issue we'd like to sort of talk about today. And we have people that want to flip properties using their IRAs. And I think that a lot of them think that, well, gee, if I flip these properties with a Roth IRA, I'm never going to have any tax on this thing. So what sort of comments do you have for people contemplating that, and what kind of restrictions? And I think that when we look at retirement accounts, I always look at two issues. What are you buying and who you're transacting between or for the benefit of? But when you engage us to put one of those accounts together, our accounts are going to allow you to make any investment the law allows, which is pretty darn wide open. So we've had people come to us wanting to do this. And so what do we look at, and maybe some things they need to consider before moving forward?
Yeah. So first off, if they are looking at flipping properties, who's doing the work on the property, and if it's an IRA, traditional IRA, Roth IRA, any of those vehicles, then they are considered to be
401k plans too.
Disqualified parties, and they cannot do the work on the property. Okay, they're as a disqualified party. If you do work on the property, it doesn't matter if you're paid for it or not. It's a prohibited transaction, and which is a big deal. You engage in a prohibited transaction, and the entire IRA is kind of up for grabs as far as the IRS is concerned. They can treat the entire IRA account as though it's been distributed and taxed.
And they have no sense of humor about that.
Yeah. So that's a big question. Who's doing work on the property? If they're going to be hiring the work out, having somebody else do it, fine. They can buy the property. The work's done by somebody who's not a disqualified party. In the case of like an IRA LLC or 401k plan, the contractor has a contract with the plan or the LLC, and that entity will be paying that party to do the work on the property. But because it is a fixer and it's something that's not purchased as an investment hold, they can have UBIT taxation, or unrelated business income tax. So where normally they buy a piece of property, hold it, maybe whether it's land or rental property, if it's purchased with the idea that it's going to be held as an investment property, when it does come time to sell it, that may be a tax-deferred transaction, or in the case of Roth, a tax-free transaction, really, as far as all the gains on it. In this situation, again, if it is if it's just a flip property, that was their intention going in, then the UBIT taxation can come into place.
So if we go back to younger David and Thomas, back to our roots, I mean, if you look at flipping property, if you're flipping property with money out of your pocket, I don't care what you call yourself, you're not an investor, you're in a business. And the consequence of flipping property means it doesn't matter how long it takes you to fix a project. You held it for resale. You're never going to be entitled to that long-term capital gains treatment. If you're buying it, fixing it, turn it, doesn't matter how long it takes, it's normal income tax, and you lose the ability to do an exchange. So there's a court case, Clarkowski, that you and I were taught years ago, 9 points used to determine dealer status, and we use that and apply it to our 1031 clients with respect to their ability to handle an exchange. But I like to use that same court case to look at our qualified money investors and whether they're conducting business or they're actually, quote unquote, making an investment.
Yeah. Because that really that's really the question here is what you're doing is an investment or is it sort of a business that you're running, and as you mentioned as well, timing doesn't have anything to do with it really. It's what was your intention going in? What are you doing? And the Clarkowski court case is a good puts out some good points to go off of in determining whether or not you do have a a taxable transaction.
Dealer status issue.
Yeah.
Yeah, and the thing is, if you call us up and we're not telling you can't flip properties with an IRA or a 401k plan. You just got to understand the potential tax consequences of it. And 9 times out of 10, I believe our clients that are wanting to flip properties, they want to work on them too, which, as Tom said, you cannot do. Sweat equity is not okay with respect to qualified money. So if you're in a situation where you want to flip properties and you want to literally create a business to do that, what would we do?
Yeah, we can set up a rollover business startup or Rob's transaction in which they can use their funds we form a new corporation. That corporation has a plan. We've gone through this before, but that plan is where the IRA funds are rolled into. The plan now buys into the corporation. The corporation can hire you as an employee of the company, and now you can do work on the property. Or you can have it, the plan hiring other contractors as well. But that's a situation where you can go forward and actually do work for the property.
So if you're just merely making investments, we can use a checkbook IRA, which is a combination of IRA and a limited liability company, or we can use, if you're self-employed without employees, solo 401k is going to give you that ability to go do those things. It's great for making investment. If you want to actually work on things or conduct business, then we're going to shift gears to the rollover business startup, which is a combination of a 401k plan and a C corporation. It's got to be that way. And I guess a comment I've got to make on that is anytime we're looking at moving IRA money into a 401k plan, understand that we're not going to be able to roll Roth IRA money into the 401k plan, nor are we able to roll an inherited IRA, beneficiary IRA into that 401k plan. So you're going to source that rollover business startup 401k plan or solo 401k with pre-taxed money, and we can use SEP or simple or traditional IRAs. All that stuff's going to work. But once again, call up, ask the questions.
Yeah, and with respect to these fixer properties, if you find something and it needs work, and it's really that value add that's going to be, give you a really good investment, certainly you can do that. You might want to consider holding it as a rental property for a period of time afterwards. If you buy a property and it needs some work done to it, you can certainly do that with your pre-tax money. It's not taxable, unless you were to sell it right away. But if you now hang on to it, rent it out for a period of time, maybe you rent it for a year and a half, and now you've got a situation where you've got a solid income on it, and maybe it's time to move again, buy something else. You can certainly do that, and now you're selling an investment rather than a just fixer property.
So just tongue-in-cheek a little bit here. So does a property have to be rented out to be considered held for investment?
No.
No. So you think about San Diego's got a proposal out there. They want to charge people $5,000 a year for empty bedrooms in their houses. Or you look at Portland now, who, our wonderful mayor just proposed that, I don't know if they're moving forward with it, but they want to be giving people $1,000, for a bedroom. And people, if they jump on that, and by the way, so one, you don't have to rent it out, but two, if you are renting something out, what do you have to do? Depreciation, right? I mean, it's not elective. So these people that want to rent out, I don't know why you'd want to rent out a bedroom in your house, but if you're going to do that, or the attached dwelling units in your backyard, understand that you are now converting what was a primary residence into a portion of it's an income property, and if it's rent out, you have to take depreciation on it. So a future sale, you might think, well, I get the exclusion 121, the 250 or 5. You're in a situation where you're no longer going to do that, and if you're just going to sell, now you're going to have to pay tax on depreciation recapture. So all these wonderful ideas by our politicians that don't really understand what the consequences of these actions are I think, really baiting a trap for the general population.
Yeah, and with our properties that are acquired through your IRA, if you have an IRA LLC, checkbook IRA, you cannot take depreciation. The IRA LLC cannot take depreciation. I was going to say that with these things, whether it's the IRA or 1031 properties, if you were to, again, timing's not what is really of primary importance here as far as hold periods or anything. If you were to go out and buy a property, again, whether it's with your IRA or through a 1031 exchange, if you did not intend to sell it right away and somebody came up to you and offered you a great deal more than what you paid for it, that's not going to be considered a flip property. It was purchased. What was your intention when you bought it?
Great
point. And if it was intended to be an investment for you, then you still have a valid reason to be able to sell and not have to pay taxes for the IRA, or you can certainly do an exchange again for your 1031 properties.
We've had situations, uncontrollable job changes, health situations, financial hardship, or like COVID when it hit. All of a sudden, in our state, all of a sudden, the governor said, well, gee, the tenants don't have to pay the landlord. And the landlord's still sitting at a bank statement that the bank's needing to be paid. And yeah, I talked to somebody recently. It was sort of interesting. I was on a walk around Mission Bay with another couple, and so she was up there talking with the gal, and I'm talking to the husband, and he was talking about a situation where his in-laws had been school teachers, and they had retired, and they had moved to Seattle area, and bought some income properties in their retirement with their money, and all of a sudden COVID hits, and they lost the properties to foreclosure because they couldn't afford to make the payments, and the tenants weren't making those payments. And politically, they were very, very liberal. I'm sorry, I'm going to go a little bit political at the moment, but they were very liberal in it. But they still didn't, even after losing the properties to liberal policies, they moved from Seattle to, I can't remember, Wyoming, I think, is where they've now moved, and now they're upset at the politics of Wyoming. And it's like, haven't you learned anything? I mean, it's sort of interesting. But elections have consequences, policies have consequences. Understand what happens when things get put in place. It's not without consequence.
Yep. A lot of these cities they've implemented landlord-tenant laws, which are very unfriendly towards the landlord, the property owner, and it has prompted a lot of sale transactions much before what their anticipated sale might have been.
Yeah. So I hope that helped clarify situation with investing or flipping properties with qualified money. You can definitely do it. You cannot work on the property. Sweat equity is not okay. You can oversee the projects and coordinate everything, but you're not going to go out and get dirty on it. So, and be aware that, as Tom said earlier, if you're truly flipping the property, you're going to be subject to that unrelated business taxable income, UBTI. And that's one of those things you want to talk to your tax people about on any of these transactions. So thank you so much for spending the time with us today, Tom, as always.
Thank you.
And Dave and Tom Moore, the Exchange Bros. And this segment is for IRA Advantage, our self-directed retirement company. And you can take a look at IRAadvantage.com or .net. Thank you. Look forward to talking soon. Bye-bye.
Bye-bye.